Good evening and welcome to another episode of the Weekly Market Wrap. My name is Daniel Ang. Today, of course, is the last day of November, November 30th, 2025. And going into the last month for the year 2025, I do expect volatility to pick up as what we have seen in November. But there are a few things I want to focus on, namely on the impact of rising yield around the world, and we will talk a little bit about its impact and what we can expect from it. Okay. Now, without going into the content just yet, I want to remind you that this presentation is not an offer to buy or sell any kind of securities, be it futures, options, CFD, FX, or even cryptocurrencies. And the trading of any kind of margin products, including financial derivatives, do include the element of risk. So make sure you are aware of your risk profile before you attempt to trade any kind of margin products. And I'll be expressing my views in the various outlook, and do understand these are my views, and no responsibility will be accepted as a result of attending this presentation. Now, the content of this presentation has not been viewed by any regulatory authority, including the Monetary Authority of Singapore. So if you're okay with that, let's get started. Now, the first economic data that came in this past week has been the core producer price index year over year for the month of September. Now, remember, this is a few months late, so this is not the most current data set, and we will be getting those as more data has become available. But for September, we can see that the inflationary pressure has actually dipped from 2.8% in August to 2.6%, even marginally lower than the market expectation of 2.7. And there was a revision upwards from 2.8 to 2.9 for the month of August, so do take note. So from 2.9 to 2.6, obviously we can see that the producer price index, at least the core, which is removing the impact of food and energy, we can see that it has been coming down. But this is not the complete picture. Now, remember, this is delayed data, so it is not current. So do not put too much focus into it because it is a delayed data. Okay. Now, the other thing that actually will be quite significant will be the retail sales. Retail sales has actually come off. We can see retail sales month over month for the month of October has gone down quite dramatically from 0.6 in September to 0.2. So this is a massive move downwards. So considering that the retail sales is a major component of the US GDP makeup, I've always mentioned that retail sales accounts for roughly 70% of what makes up the GDP. Okay, so if GDP going forward, we do expect Q4 GDP to actually be negatively impacted. Now, the control group, of course, we include other stuff. We take out a few items. You can see that has also been very bad, although there was a slight revision from 0.7 to 0.6. And what really impacted the market was a negative 0.1 reading for the month of October. So this is way bad. Okay. So we can see that retail sales, as far as the control group is concerned, has been quite stagnant in the sense that it has been trending sideways between negative 0.5 to positive 1.2, I believe. Okay, so we can see this dip back into the negative territory. It only happens four times this year. No, three times this year, including the latest reading. Okay, so the worst reading was in January. It was negative 0.5, followed by the reading in April, which is negative 0.25. Now we can see is negative 0.1. So we are back in negative territory, meaning to say that retail sales has actually slowed down, meaning to say US consumers are definitely on the rope, and this is not good going forward if you want to take a look at how robust the US economy has been performing over the last few months. Again, this is not the latest number. This is a delayed number for October, but the fact that it is all going backwards is a sign for concern. The consumer confidence index coming in from the conference board, which is a number that I don't normally look at, but because there were no other data to look at, so I take a look at the consumer confidence index, and it was really bad. Okay, for the month of November, so this is relatively current. Okay, we can see US consumers measured by the conference board has actually dipped to a number that is second worst in its history, and this is the lowest since April. So again, when you look at it in tandem with the retail sales, it is definitely not a good sign for the US economy. And a lot of people are saying this past week that because the retail sales is really, really bad and confidence has actually dipped to such a level, the prospect of a December rate cut looks like it has again been bumped up. Now, going into this past week, sentiment is that there is no guarantee that we're going to get a December rate cut. But after this past week data set, a lot of people will now recalibrating their estimates, saying that the likelihood for a December cut now has gone back up again. In fact, it has gone back up to 80%. So whether this is going to be something that will happen, we will continue to watch going into December. Okay, but that will not happen until the second week of December. So going forward, we need more data set. If this past week, this coming week, we continue to see data suggesting a weaker economy in terms of the labor market, especially, then that may actually bump up the likelihood of a December cut. But based on what we have seen so far, the Federal Reserve is definitely waiting to see more hardcore data coming in before they make an announcement. Now, incidentally, just 5 minutes ago, I read a news article suggesting that the Fed Chairman Powell may actually resign or actually announce his resignation tomorrow. So tomorrow is going to be interesting whether this comes to be, because the Fed chairman don't have to, his term ends in May of 2026. So there is no urgent reason why he should resign 6 months before his term is up, unless something extraordinary happen. Okay, so we will want to continue to monitor this development. If it does, then it will definitely be market moving. We can see that precious metal has already started to react, although it was a thinly traded week. Now, remember this past week we have Thanksgiving Day, so it is a shortened trading week. Volume is definitely not as robust as previous week, but it is a sign. Okay. As far as the Fed officials are concerned, we have Mary Daly, the president and CEO of the Federal Reserve of San Francisco. She is now backing a December rate cut. Okay, so we can see that in the previous FOMC minute, we can see that there are dissenting voices within the FOMC, and more Fed officials, especially those with voting rights, are now leaning towards another rate cut in December. So whether that will be the case, again, we do not know for sure, but we are getting a reading of the various officials. Now, the other Fed officials that is leading towards a December cut is this guy, Christopher Waller. He has been calling for rate cuts over the last 4 or 5 months. Okay, so he is been at least consistent with his messaging that he believed that between the dual mandate of encouraging economic growth and taming inflation, he believed that the most urgent task at hand is to make sure that the US economy remains supported by lower interest rates. Okay. Now, going into this, I want to spend a little bit time to talk about the elevated US Treasury yields. We can see that US Treasury yields was northward of 5% at some point in time, especially in 2023 and then again this year. Okay, so we can see that even though we have 2 rounds of rate cut, okay, already in the bag, and with another possibility of another cut in less than 2 weeks' time, we can see that the 30 years bond, which is a long bond yield, it's still very high. Okay, currently it's trading way above 4.5%. So this is a problem. And it's also one of the reasons why President Trump has been particularly on the case of the Fed chairman asking him to cut interest rates. He has gone so far as to intimidate, threaten, and basically telling point blank that you need to cut interest rate because $9.2 trillion worth of bonds need to be refinanced. And if they have to refinance at anywhere near this kind of rate, it will definitely be a big problem for the US Treasuries. Okay, we already knew that the US Treasury is paying more than $1 trillion a year just to service the current liabilities. Okay, but if interest rate has to be, if the bonds have to be renewed, okay, to refinance above 4%, it will be a problem because purely because we can see that U.S. Debt has been escalating. It's almost to the point whereby we can almost consider it as out of control. So if interest payment to service this runaway debt is elevated, at some point it will be a drag on not only the economy, but I think it will be a disaster waiting to happen. Okay. And the US is not alone. When we look across the developed world, especially across the G7 economy, they are all having the same set of problems. Now, this is the latest. We can see that including the United States and the other six major economy make up the group of seven, the richest nation on earth. We can see that the yields on their long bonds are all very, very elevated. Even Japan. Now, Japan is a special case. Now, even so, Japan's yield is now way northwards of 3%. And it is definitely impacting markets. So much so that I think it is possibly one of the catalysts that caused Bitcoin to actually unravel big time. Okay. Because at this current yield, anybody who have borrowed cheap Japanese yen now will have to confront with the possibility of those yen carry trade not working out because the cost of keeping that Japanese based yen, the Japanese yen loan has become more expensive now to the point whereby uh, these people who have previously engaged in the yen carry trade would now have to dispose of assets to pay down their loan commitment. So this will have a ripple effect around the world. Okay, for all we know, this could be also one of the reasons why, and the timing is such unique that I take a look at the timing of the first time we have any inkling that this could be a problem. I'm talking about the Japanese 30-year bonds yield at northward of 3% becoming a drag on the asset management space has been that is evident right now that money managers are unloading their assets just to unwind the yen carry trade. And the most visible one has been 2 weeks ago. We saw how U.S. equity markets has actually come off quite a fair bit. And in tandem with that, we also saw gold prices come off. We also saw Bitcoin prices comes off. Now, Bitcoin is still negatively impacted, okay, as we are speaking. So whether this is going to be something that we will need to be concerned with, I think logically we should, okay? Now, this is the piece of news that came in middle of the week. We can see here the headline says Japanese yield shock threaten global markets. And I have included here a BTC chart on the right, which is Bitcoin. You can see that on August the 6th, Bitcoin hit an all-time high of 126,000 thereabout. And within a span of less than a month, okay, it has gone below 90,000 and was flirting with 70,000. Okay, and of that, we see this past week we have a bit of a rebound now, currently trading at about 90,000 thereabout. But the rebound is not a sign of a turnaround, okay? Because there are a lot of people in the yen carry trade. Nobody really know how big the yen carry trade is. According to this report, it is worth about $20 trillion, okay? Which is massive. So if these people start to unwind, they will have to sell assets, and this asset usually impact across and the entire risky asset space, okay, including equity markets, including risky assets such as cryptocurrencies. So we can see that is something that we want to definitely be concerned with because we are going into the last week, the last month of 2025. We will be seeing further sell-off in assets from these people who are trying to unwind the yen carry trade. I think this is something truly we need to keep our eyes on. Going forward into 2026, I do believe the massive national debt carried by all the mature economies is likely to be a problem. And although the UK has announced the budget, the market did not react whatsoever because they actually was leaking the content of the Chancellor of the Exchequer. Her name is Rachel, and she has basically been leaking what she wants to say. So by the time she announced the budget, the market already knew what are the key a highlight of her budget. So there was hardly any movements in both the currency as well as the bond market. The one that we really, really want to watch is actually Japan. Okay, so once Japan starts to hike interest rates, that will actually be the problem here because they have recently announced a massive stimulus package amounting to more than $110 billion. And the market doesn't like the fact that they are trying to stimulate the economy at this current juncture. And we are beginning to see the Nikkei begin a little bit of a pullback. The Japanese yen is flirting with 159, so it's definitely not a good sign. So going forward, make sure we continue to monitor what's happening in Japan. And if the $110 billion package of stimulus package is actually approved by the Diet, which is their version of parliament, then it likely to reverberate through the global financial markets by sales of most risky assets, including equity markets. Okay. The other thing that came in was Ukraine, of all country, has actually sent signal that they are not against the 28-point peace plan promoted by President Trump. Okay, and the timing couldn't be more awkward because it was also about the same time news report saying that the corruption case surrounding individuals around the president, which is President Zelensky, is becoming too hot a potato, forcing the president of Ukraine to come to the table. Okay, so right now nobody knows. Okay, because Europe is definitely not in favor of the 28 points peace plan. They have put forward their version of 24 points peace plan, but I know by and large Russia is definitely not going to buy it. Okay, at the end of the day, Russia must agree to the peace plan before it can actually be effective. Okay, so without the Russian agreeing to any of the peace plan, it's going to be difficult to make this call. Okay, even though we are getting some kind of feedback from the Ukrainians saying that they are willing to consider it. Uh, but I'm not going to put my hope too high here because going into 2026, I do believe the war in Ukraine is likely uh, to escalate beyond the borders of Ukraine. And that is going to be something that I want to position for because I've already positioned myself for that eventuality. Because if that is the case, definitely certain assets will definitely benefit more than the rest. Okay. Now, we also knew that this past week we have an outage just after the Thanksgiving Day. It was quiet, and when the market reopens on Friday, there was certain asset class that was not quoted. People who trade spot gold will notice that some of the CFD brokers are not providing liquidity at all. Okay, you cannot close a position, you cannot add position, you cannot do anything purely because the exchanges that depends on the data feed has not been able to get the data that they need. Okay, so that create a little bit of problem, but luckily the trading was very light. So it was not negatively impacting the marketplace. But imagine if we are in the middle of a regular trading session and the futures exchange, which are owned by the CME group, which is quite a handful of them, including the CME, we have the CBOT, we have the COMEX. So we can see that if that is the case, then a lot of markets in the States will be disrupted, and this will may cause problem going forward. So this is not the first time that we have outages in the exchanges. This is probably the third time in my, if I remember correctly. So these things can happen. If it happen again during a very busy session, it will be catastrophic. But luckily this time it was right after Thanksgiving Day and trading was actually quite tempered. Now, this is the last piece of news that I saw this afternoon, was that Trump actually declared the entire Venezuelan airspace closed. Is this a prelude to a campaign targeting Venezuela by the US military? Or is it something else altogether? I do believe at this point in time is likely to be a siege, maybe it's a blockage, okay? Not so much a physical intervention into Venezuela, okay? But I think it is definitely a all-round blockage of Venezuela. Principally, they cannot sell anything. Okay, nobody can come in, nobody can go out. And we also knew that Russia has some frigates parked, okay, in Venezuela, and China has actually have also some assets there, okay, in terms of their perhaps I think it is maybe air defense equipment there. So I don't believe the US will risk a direct confrontation. More like it's going to squeeze Venezuela by not allowing anything to go in, anything to go out, in particularly the oil export. Okay, so again, this is something that has just developed, which I read this afternoon. Whether this is going to be impactful, I think that it will be. We are beginning to see natural gas reacting to the upside. Crude oil unfortunately did not react in the manner that I expected. Okay, yes, actually dipped in the last hour of trading on Friday, but this is definitely something bullish for energy markets because Venezuela, after all, is a major oil producer. Okay, now, going forward into the coming week itself, we have a few key economic data that's in the pipeline. We have Monday, we have the manufacturing PMI, which is the Purchasing Managers Index, and this is a set of data from ISM. So we want to watch this data set. They also saw this PMI to be a little bit softer at 48.6 compared to the October number of 48.7. We're also going to get private employment data change. We can see that the last number was 42,000 jobs being created, which was a great number. And this time it is half to 20,000. Okay, so the expectation is that the private employment sector is also on the road. Then we have the IMF services PMI numbers for November, also expected to dip from 52.4 to 52.1. Then on Friday, we have wrapped up by the personal consumption expenditure. Now, this is the number that the Federal Reserve will actually watch in terms of gauging the impact of inflation. It is likely to stay stable, whether it is on a month-over-month basis or a year-over-year basis for the month of September. Again, this is a delayed data set. This is for September, so it may not be that impactful. Okay, that is going to be wrapped up by the Michigan Consumer Sentiment Index for the month of December. They expect consumer confidence to actually come up a little bit ahead of the festive season come December. Okay, so this is what we can be expecting going forward. Okay, now we will go into the chart itself, and if you have any question as we go along, do pop your question into the chat box so that we can address them as we go along. Okay, so here we have the end of the month for November. We can see that for the Dow Jones, it actually ended up positive for November. Okay, marginally, but it is still positive. Okay, so for the Dow Jones, it is perhaps signaling that the correction that we have seen could be over and the market could be getting ready to resume its 16 years back bull market. So the last number was 47,705, not that far away from the all-time high of 48,456 and a half. So from the monthly perspective, it does looks like the bull market has not been seriously damaged by the pullback that we've seen in the middle of the month for the month of November. So this is the weekly time frame. You can see that there were 2 months in which prices actually pulled back right after a new high was traded at 48,456 and a half. So we can see the closing on a close basis. Okay, this is a very positive development because on a close basis, this is the highest closing that we have seen for the Dow Jones. Okay, so remove the intra-month trading activity. This is definitely a very positive sign. Traders will take note that the Dow Jones actually closed positive for the month of November despite the rather sharp pullback. So this will actually set the stage for higher prices, in my opinion, going forward. Okay. Even in the daily time frame, we can see the market actually pulls back down. Of course, there is a possibility of another dip, but all said and done, okay, once the market take off 48,456 and a half, it is the confirmation that we need that the correction that we saw in mid-November is practically over and the market could be extending its run all the way from 36,500. Okay, so this is the outlook for the Dow Jones. Now, the other index has also rebounded. Here we take a look at the S&P 500. We can see that on a close-on-close basis, although it did not trade it into a new high for the month of November, the high was actually traded into the last few days of the month of October. But on a close-on-close basis, again, it is close marginally higher than in October. So this again should be seen as a positive sign, very much in line with what we are seeing on the Dow. This is the weekly time frame. Now, when you take a look at the closing price on Friday, we can see that it is marginally at the all-time high. Okay, on a close-to-close basis, it is actually at a high. So both the monthly and the weekly time frame tells me that the market is still very much in the bullish phase. So don't be surprised if we see new highs being created into the last month of 2025. So this is the daily time frame. Market has been supported by the cloud here. You can see the low traded was 6,508.2 and it's getting ready to ramp higher. Once market take out 6,925, it is as good as the market has resumed because this counter trend will be eliminated. So both the Dow and the S&P 500 looks good for uh, a resumption of the bull market. Now let's take a look at the tech stocks in terms of the Nasdaq. Okay, where's my Nasdaq? Here, Nasdaq 100. When we look into the monthly time frame, here is a monthly time frame. Uh, it's not as great looking. It did not close on a high. Okay, unlike the Dow Jones and the S&P 500. On the close basis, it did not close higher than October. So that was a negative. But overall, we can see that the market has actually recovered quite a fair bit from the bottom that we saw in November. So in the weekly time frame, this is actually quite clear. Okay, uh, market is getting ready to perhaps even follow through on uh, the bullishness that we see in both the Dow and the S&P 500. So all seems to be pointing for further gains. The daily time frame has seen a three-wave pullback supported by the cloud here, and like I said, all signs suggest that we probably will see a challenge of the all-time high, perhaps creating new all-time high. Okay. Now, the Russell 2000, okay, has actually had a good month, okay, on the basis of lower interest rate expectation for the month of December. We already have saw two rounds of rate cut, and if we end up the year with another rate cut, if the quantum is 25 basis point, I think it is already quite a motivation for people in the small cap area to actually launch uh, to take out the all-time high in the Russell 2000. The current high is 2,547 and a half. Okay, so there's a very strong closing this past week, suggesting that there is momentum behind this uh, uh, recovery. In the daily time frame, again, we have a bit of a dip below the cloud, but only marginally. We can see now the price action is above the cloud, getting ready perhaps to launch an assault on the all-time high of 2,545 and 9. Okay. I'm not going to show you the lower time frame, but because they are all quite positive looking. Okay. So the conclusion I get is the US equity market may have finished its corrective pullback and is probably getting ready to continue to resume its 16 years bull. Okay. And in Europe itself, when we take a look at the DAX, okay, DAX has also recovered on a weekly basis. This is a weekly time frame. It has gone flat, okay. Basically, has been trading sideways for quite a few months now. For the last 4 or 5 months, it has been basically been consolidating, and for all we know, it could take its cue from Dow Jones. Okay, if the Wall Street itself actually stabilized and created new high, it may be enough for the European equity to also follow through to the upside. German DAX on the daily time frame is relatively weak. Okay, we can see that overall the market is bullish, but the price action are below the clock, and the clock has been basically quite thin, meaning to say it can actually break at any one time. So again, it is poised, okay, to have the possibility of continuing to explore higher levels going forward. Now, let's take a look at the FTSE, okay. This is the FTSE, which is the UK index. Again, we can see that the pullback is looking very much like what we saw on the other US equity index, getting ready to, or basically it's poised to recover. Okay, although it is not as strong looking as what we saw in the Dow and the S&P 500, but it is not showing sign that it was going to collapse, especially after the budget has been cleared. Okay, here in the technical outlook here, we can see the price in the FTSE has actually tested the upper edge of the cloud here. And so far, although it has only recovered back 50% of its drop from 9,930, 940, but it's looking tentative. Okay, it's not as strong looking as those on Wall Street. Okay, but like I said, if Wall Street does well, it may actually spill over into the European theater. Okay. Over in Asia, we want to take a look at the Nikkei 225. Now, the concern here is whether the stimulus package that I was mentioning earlier on, the $110 billion stimulus package, can actually be approved by the Japanese parliament. Okay, so the market has actually pulled back because of that fear of the unwinding of the yen carry trade. Okay, so the sentiment is actually quite jittery right now. Okay, because the yield in the JGBs are now at record highs. Whether you're looking at a 40 years JGBs, the 30 years JGB, they are all at record high, which is not a good sign. Okay, and market do believe that Japan cannot afford another stimulus package. Okay, so if that's the case, sentiment in Nikkei could actually be negative from the perspective of the possibility of unwinding of the Japanese yen carry trade. Okay, again, we want to wait for news for the uh, parliament approving that stimulus package being proposed by the new Prime Minister Sanai Kataichi. Okay, here we have the daily time frame. Market has a three-wave pullback. Technically, it would suggest that the technical pullback is over and the market could be getting ready to resume its climb. Okay, here we have a very technical outlook here, three-way pullback to 48,000 and it's stabilized above the cloud here. And from the technical perspective, it has every possibility of gunning for the all-time high again. Okay, in Hong Kong, we're also seeing something very positive. Here, Hong Kong, as we knew, the market has been quite elevated. We have a high for the year at 27,424, and the market, although it has quite a sharp drop, there was no follow-through selling. Market actually stabilized and currently trading at 26,000 thereabout, and it's not that far from the all-time high. Not all-time high. I think the high that we've seen so far this year. There is the possibility market may resume climbing again. Okay. And in the daily time frame, we have a very neat three-way, although it did not quite hit equality. The market did not quite take out this low at 24,949. Okay. So, but there was a close attempt at 25,026 and a half. Not quite ideal. Okay. Of course, it can always continue downwards to try the 24,700 target here of a AB equal to CD three-wave pullback. But prices are still not above the cloud yet. Okay, so we have to watch for confirmation here. Once the price action can close at least one day above the cloud, it will actually bolster the bullish outlook for the Hang Seng index here. Right, I have finished the equity index. I want to move on to currencies. We can see that the dollar has been on the rope this past week. In terms of the weekly time frame, we can see that there was some tentative attempt rally, okay, uh, attempt to rally. The low traded in the dollar index, which is a basket of currencies, namely the euros, the Swiss franc, the Japanese yen, the sterling pound, and the Canadian dollars, and perhaps even the Mexican peso, has been in this basket, but it is overwhelmingly in favor of the euro. So the dollar index here, you can see the low traded this year is at 96.16, with markets has recovered back for the last 2.5 months, 3 months, but this week itself it closed negative. Okay, so will we see follow through selling in the dollar index? We are not quite near the end of the year just yet. So for the year 2025, we possibly could see dollar ending weak. Okay, so there is a possibility where we may see further weakness, at least in the near term for the dollar. Okay, so here is the dollar index on a daily time frame. We saw a very neat three-wave bounce, not quite ideal in terms of its logical target for a symmetrical recovery in a three-way structure, that would have caused the dollar index to go back and test the 101.50 levels. And we know that high traded is only marginally above the 100.32. Okay, so but for now, we can see that yes, price is above the cloud within a counter trend rally. Okay, but if you draw this support line, the market has officially closed below the line. So that is two possible outcomes. One is that we see follow through selling for the fact that the market has broken a support layer, but because the price action is above the cloud and is within the positive rebound in the counter trend here, so it could be mixed. Okay, for all we know, I don't have very strong opinion about the dollar going into the first week of December. Okay, because both can actually happen. Okay, so like I said, maybe this coming week may not be a great week to be concentrating on currencies. Okay, in the euro, which is basically a mirror image of the dollar index price chart, we can see that the three-wave bound hit equality at 1.1919. Okay, and then went into sideways consolidation with a little bit bias to the downside. So it is not indicative of whether the market will continue to trade lower. I am of the opinion, which I have expressed continuously in this segment here, that I am long-term bearish on the euro. Okay, but it does look like that this past week we see a positive closing for the euro versus the dollar. So for all we know, we could see some more consolidation, perhaps even gaining some ground relative to the dollar. Okay, this is the daily time frame. You can see positive outcome. The market on the daily time frame is basically in favor of further gain in the euro, although we have a counter trend from 1.1919 all the way to 1.1470. Okay, again, it's a three-way pattern, not quite ideal to the target here, which is will be targeting 1.135. Okay, so this is not indicative of momentum. So market may actually be ranging for another week, perhaps into the year end. Okay, I think next year we probably will see a more definitive direction bias in the currencies. Okay, but for now, I think the market is just marking time. In the sterling, even after the budget was announced, sterling did not really move in any big way. Okay, so the market is actually quite stable. We have a three-way pullback in the euro sterling versus the dollar from a high of 137.90, and if this is the case, it would suggest that this three-way pullback will have finished the corrective pullback. The market may still be in favor for further gain in the counter trend rally for 103.60. Okay, so this is a counter trend, not the main trend. So if that's the case, very similar to the euro outlook over the long term, I am bearish on sterling over the longer term. Okay, in the daily time frame, this three-way pullback is actually quite clear. The market has actually corrected very nicely, theoretically, into between the ideal target of AB equal to CD at 130, 130.80. Okay, so we have a low at 130.10, so it's more than enough to say that we have a very technical pullback, satisfying the minimum requirement for a technical pullback, and the market may be resuming its dominant trend, which is suggesting we probably will see higher prices, at least in the in the near to medium term. Okay, but I don't expect big move to come in the currency market just yet. Now, the other currency pair I'm always looking at will be the dollar versus the yen. And we can see that the Japanese yen has been weakening against the dollar. The dollar has actually climbed back to retest its recent high near the 159 level. Now, this is a danger area because once the market clear 159, approaching 162, the risk of a intervention by the Bank of Japan and Ministry of Finance for Japan may actually be quite great. Okay, the Bank of Japan may not be in sync, okay, with what the Takaichi government wants to do because she is definitely against the rate hike. But I think the Bank of Japan has their own mandate. They are looking at elevated inflation, looking at the yields in the JGBs, and I think they have come to a conclusion at some point they may have no choice but to be focused in taming inflation, and that means having to hike interest rates. So if that's the case, then of course the dollar yen may come off. But if they do nothing in December, which a lot of people were saying that they may have to make a move in December, okay? And if that's the case, then maybe there will be some serious challenge of this 162. Okay. Now this is the line in the sand. 159 to 162 is the line in the sense if the market persistently want to push the dollar yen pair above, then the Bank of Japan may be under a lot of pressure, perhaps even forced to intervene. Okay, so do watch out. I think if there's going to be any big move, it could come in the form of a central bank intervention in the dollar versus the yen. The way time frame has positive, you can see that the overall trend in the dollar versus the yen is very bullish, okay? And the market has just recently taken out a technical cut point in the sense that this is a resistance line. Market has taken out and closed above and did not quite pull back. So if this is the case, the odds of continual uh, of an extended rally in dollar yen is actually better than normal. Okay, so if you take a reverse three-way rebound, meaning to say, if I want to measure the potential for a three-way rebound from 139 half, okay, we could possibly see in here. Okay, I want to remove the 68. Remove this, put this at 100. Okay. Then there's a possibility market will go back and chase this side. Okay, this is a classic AB equal to CD. If that pans out, we are looking at 159, just marginally above it, just enough to take out this high, marginally. Okay, before we see a reaction. Okay, this is the outlook for dollar versus the yen. Let me take a look at perhaps the Aussie dollars. Uh, yeah, this is the Aussie dollars. Aussie dollars, nothing much happened. The market is in sideways consolidation. It has been like this since the middle of the year. And there is every possibility it will continue to do sideways pattern. Okay, so right now the range trading is about 63 cents to 67 cents to the dollar. Okay, so this week it has a stronger closing compared to the previous week. So, but it is still very much in sideways consolidation pattern. Okay, there is no clear sign as which way it will go. Okay, the dominant trend still favor upside. Prices is not above the cloud. So it's a bit of a mixed signal. So I won't be taking any uh, position in the currency market, at least in this coming week. Okay. So that being the case, nothing to see in the currency market. I know there's one of you wanted to see sterling yen. Now, this one could be moving. Okay, sterling yen could actually be very bullish. Okay. So sterling yen on a monthly basis is now currently looking to challenge the high here at 208.10. Okay. There's every possibility now that the market is above the AB equal to CD range. It may actually take out its high here at 208.11. Okay, creating a high. In the daily time frame, it is very positive. The market is trading in a very neat channel from the low of 184. 40. Okay, so long as the price trades within the channel, the rally will be quite limited. But if it closes above the upper end of this channel here on a daily basis, then it is a breakout. Okay, so and then because this is so near this high here at 206.11. So overall, I do believe that we are beginning to see some positive move in the crosses, especially against the yen. So not so much against the dollar, but I think against the yen is right now on the defense. Okay, so any pair, any currency that's traded against the Japanese yen is likely to be well beat. Okay, including the sterling versus the yen. So this is my 2 cents worth. Okay, there's a question here. I want to catch this question. Is there any? No, there's no question. There is a question. Okay. Can I please share cloud setting? Not in this session. If you want to know about all this cloud setting here, that will be a training course or training session. I don't want to go into that because it's not what my weekly market rate is all about. I just want to give you my outlook. Okay. So if you are very keen to know about the cloud formation, it's basically Ichimoku. Okay. If you can Google it, Ichimoku have five parameters. I do not need all the five. I only need the Como, which is the cloud. Okay, you can see that it acts as a primary and a secondary support and resistance. Here you can see based on what we can see so far. Although I'm not going to go into explanation of the Ichimoku, you can see that every time the market hit the cloud, it provides as support. Okay, but it's not one single line. It is a dynamic, okay, support and resistance line. Okay, so it seems to be working very well for me. That's why I include that into my chart here, just to have another layer of confirmation. Okay, so if you have any other question, again, don't be shy. Just put them into the chat box. I will address them. So, okay, right. I want to go on and show you the other currencies, or in fact, the other commodities. Gold has a good outing this past week. We knew that gold has quite a bit of a pullback from $4,381 per ounce, go down to 3,000, just below $3,900 per ounce. And this past week has been a very strong closing. Is it suggesting the return of gold and perhaps even a possibility of creating new all-time high? Okay, I think gold is a metal right now. It's a monetary metals, monetary assets, and I think it is very well bid, especially when you look into the chaos created by the unstable geopolitics and about the rapidly deteriorating debt crisis in a lot of developed economies. So you definitely want to hold on to gold. I think central banks look at gold as a store of value, not so much as to make money from gold accumulation. But I think they feel that there is a inflection point in the global monetary system whereby the dollar is no longer as reliable as it used to be, purely because the debt is simply out of control. So central banks uh, definitely want to be on the defensive. They want to make sure they take steps to actually protect their national wealth. Okay, so accumulating gold is definitely something that will happen in the years ahead. I do suspect that we probably will see much higher gold prices. The first resistance for gold, in my opinion, is about 4,005, and of course, the very nice round number of 5,000. If gold prices does break through 5,000, I do believe it will go parabolic. Okay, but for now, I think the immediate resistance, technically speaking, although we are in uncharted territory. 4,005 to 5,000 seems to be a logical area to expect some kind of resistance. Okay, but for now, the momentum seems to be suggesting that we may be seeing the return of momentum in the precious metal space here. This is the daily time frame. You can see that gold prices did not quite finish a three-wave pullback. It has a very minor one, okay, a very minor three-wave, okay, but then overall the risk of a larger three-way pullback testing the 3,750 to 3,770 remains a distinct possibility. Okay. Again, once the market take out 4,381 and a half, it's definitely the confirmation that the pullback is over and the market is in a new phase. Okay. To show you the pullback, you can see this is a three-way pullback. It went into this order block here. Very neat. Okay, you can see that the market actually went down, okay, to test this area of demand. Okay, and it briefly stayed there for 1 day, not even one day, and then it bounced back up. Okay, so far the rebound here is not very impulsive just yet, but prices are above the cloud on the 4 hours time frame. Okay, so normally I will take a look at the daily. I will give the daily cloud here a little bit more prominence. Okay, you can see the market has briefly touched the upper end of cloud, found support, and unless it comes back down again, unless it breaks the lower end of this cloud here, uh, and then even then, if it does breaks, I would think that AB equal to CD somewhere between 3,750 to 3,770 may actually hold. Okay, long term, I am bullish. If the market do come back in a more significant way below $3,900, I am definitely looking for opportunity to accumulate. Okay, so currently I have no gold position. I'm going into this week itself. I was actually short gold. Okay. I was actually short gold somewhere. Let me see. Where's my short position? You can see that I was actually short gold. Okay. Then when I take a look at the rebound, I don't feel comfortable, so I actually exit, close up my short position, but I didn't turn long. Okay, what I did was I actually turn long in silver. Okay, so when you look into silver, silver is definitely a better play in my opinion, because when you look at the overall gain for silver, it actually gained year to date 75% compared to gold gain of 55%. So this year alone, silver seems to be outperforming gold. And when we look into the gold silver ratio, it ranges from 126 down to 62, then bounce back to 105, and then drop, okay, to 80. And this week on closing, it dropped to 74. So it means that the gold silver ratios do suggest that silver may actually continue to outperform. There is a possibility based on the structure of the gold silver ratio. When I look at it from a technical perspective, there is a possibility gold silver ratio may actually drop to 40. Okay. Uh, Currently it's at 74. So it does look like if gold silver ratio plunged to 40, silver will seriously outperform gold. So I think I want to stay long on silver. You can see that I'm actually long silver. Okay. So where did I go in? I actually went in a little bit late. Okay. But I could feel that market is actually wanting to go higher. Okay. So this is the latest position that I'm in right now. On the 4 hours, you can see this is where I actually entered the trade. Okay. On here, on the break above the cloud. So I went long and the market actually surged towards the closing price on Friday. So of course, this is happening on very thin volume, so it's not indicative of continuous follow-through buying, but it looks good on the chart. So I will look for a chance to not only accumulate, I think I will continue to look to add on to the silver position, because if my outlook for gold silver ratio to plunge towards 40, there's a lot of meat in silver. Okay. Now, oil is something that came as a disappointment. I'm actually long the oil market. Okay, we can see the WTI, but it has not really rebound. I bought it on the basis whereby the production cost is definitely somewhere near $60 per barrel, and prices right now are below $60. So I would think that that would make sense to go long. Uh, but I'm prepared if the market continue to decay below $55 per barrel. In this case, I will look for other opportunity. Okay, but I am seriously bullish on energy markets, in particularly crude oil. Okay, so in the daily time frame, you can see that prices of crude oil. Why do I have this? Okay, I want to close this chat. It doesn't seem to want to close. Okay, anyway, I see that this is a daily time frame for oil. Oil prices right now is not above the cloud, so it will be a positive if we can close above the cloud. Okay, at the bare minimum, if we have a three-way bounce, at the bare minimum is $63.70 thereabout. Okay, but over the longer period of time, I am definitely bullish on oil market. If the situation in Venezuela ends up in a hot war, whereby the U.S. send in their planes, send in their troops, and that will be escalating the situation. And Venezuela being a major oil exporter, will definitely see oil prices reacting to the upside. Okay, so I'm looking at that positive outlook. But I think the reason why we saw a last minute sell off in the oil market was the development as far as peace. Okay, there is a possibility peace may actually prevail in Ukraine, especially now we have President Zelensky softening his tone, and President Putin is definitely in favor of the 28-point proposal put up by President Trump. So that could be the one that caused oil prices to actually sell off in the closing hours on Friday on very thin volume. Okay, but overall it's quite a bit of a disappointment. Okay, because it managed to close above the cloud marginally, but then again now it's back below the cloud. So this is a 4 hours time frame, not indicative of the trend. Okay, but overall, I like what I see here, so I'm taking my chance with long in the crude oil. Now, I did mention that the natural gas is actually looking very good. This is the natural gas chart, very, very positive. Unfortunately, I didn't see this trade coming, okay? And if I'm right, the wave count could be a 1, 2. This could be a very powerful move, way beyond $5, perhaps aiming for $6, okay, in the natural gas. So maybe I'm late, but if I got a chance to enter a trade, I am definitely going to be on the long side of this. This is the daily time frame. Very positive. You can see there's closing on Friday, very strong. It suggests very strong momentum behind. Okay. And Bitcoin. Okay, Bitcoin is where I think I wanted to talk a little bit about Bitcoin. Now, there were rumors circulating in various chat groups that the JP Morgan is definitely targeting not only Bitcoin. I think they're targeting MicroStrategy. The guy behind it is called Michael Saylor. Okay, and he is the one that pioneered Bitcoin Treasury. Okay, and JP Morgan is behind a lot of index. Okay, that in which money manager will have to measure up against. So according to uh, MSCI, which is Morgan Stanley Index, they don't think MicroStrategy fits the profile of being included in the index. So come December the 1st, which is tomorrow, okay, MicroStrategy could be kicked out of all the MSCI index. And that will be a problem because if you're not in the index, a lot of other asset managers cannot invest in that company. Okay, so we can see that the selling in the Bitcoin has actually exacerbated. Okay, a lot of companies would have to unload their holdings in MicroStrategy, and the other impact will be it's going to be very hard for the company to actually raise money through the capital market because purely because they are no longer part of the MSCI index. Okay, so that is also one of the reasons why we see this big move in Bitcoin. And it also come in just after a report came in that what was I trying to say? That the yen carriage unwinding is likely to impact Bitcoin as well, which it did. Okay, so we can see the Bitcoin prices came down very sharply from 126,000 all the way down to below 90,000. The lowest trade was 80,526. Okay, Dennis is asking, do I see any silver entry price? Let me backtrack a little bit. Now, as far as silver is concerned, the market has already moved. So we got to wait for the next pullback. So in the case, right now the market is so strong, you definitely do not want to be chasing this at this current price. Be patient. I suppose at the end of the day, market eventually will retrace. And if it does retrace, if this depending on what is your criteria and what is your strategy, there definitely will be areas in which you can participate. So let's say, for example, this is the 1 hour time frame. This is the lowest time frame I will track. The market traded to $56.52 on Friday. And if there's going to be any kind of pullback, now this you notice that this cloud is actually moving ahead of the price action. Anytime the price comes near, okay, or touches the upper end of this cloud, that will be a sign. Okay, if it holds, I will probably go down to the 5 minutes time frame to see if I can get a better entry levels and take my chance. And then if I'm going to be very nimble, I'll put my stop just below this low here and take my chance. If the market continue to slide below the cloud and take out $52.87, okay, will end up with a loss, but I'll try again. Okay, perhaps at a higher time frame. So for now, at least if we do see any kind of pullback, now let's take a look on a 1 hour time frame. Tomorrow morning, I'm not sure. So the price in which it will touch the cloud here will be at 53 cents, $53.17. Okay, the price do come back down and touch the cloud, but that would mean the market has to come down by at least $3. But then who dares to buy? Okay, so in the meantime, we just have to be patient, wait for the price action to eventually pull back, which eventually they will. Okay, so before it pull back, it may continue to go higher first before it pull back, but eventually it will give you a chance. Okay, so I'm not able to provide you with a entry level at this moment in time. Okay, so I was talking about Bitcoin, right? So Bitcoin, I still see that we are able to see a bit of a rebound in Bitcoin. You can see the market has actually rebound off $80 and $80,500. But I think this is part of a corrective bounce. Again, if the market goes high enough, I do not believe that we have seen the low just yet. Market is talking about $74. So where does the $74 comes from? Comes from here. Okay, in many charts across different exchanges, 74,000 seems to be a key area. Okay, so if the market can rebound back to 100,000, okay, and not beyond 102,000, then I think there is a possibility the market will come back down, revisit this low, and gun for 74,000. And that will complete a five-way structure. Okay, that will be something that I'll be keenly watching. Okay, so I have no position right now in Bitcoin, but if the market do continue to recover, I want to see how far it can go, ideally towards the $1,000 handle. Okay. I'm not sure whether you want to watch any other crypto here. I can show you the Ethereum. Ethereum currently has a very big sell-off all the way to $2,600. Again, hit the upper end of this area here, which I consider to be a what you call that, a not only a demand zone, I think it's an order block here. Okay, and the area is 2,110 to $2,635. So it did marginally went into this bracket of prices, okay, and then bounce. So there is at least immediate demand for Ethereum, but overall, I do see. Okay, maybe I should extend this, put this back again. This is a three-way. So it has hit equality. So it has technically fulfilled its bare minimum requirement. Could be getting ready for rebound, okay, into the cloud. But if Bitcoin continue to be sell off, then I think it will spill over into the other coin as well. Among the weakest is this coin here called Solana. Solana is actually quite weak. Okay, Solana has not finished its three-wave pullback, targeting $53, and the market has actually been trading below a support line. So technically speaking, I do believe that Solana may actually have a lot more to fall before it stabilizes. Okay, so you can see this is the daily time frame. The break of the support here is very clear cut. Okay, and the prices has been trading below the cloud. We have a bit of a technical rebound for $121.64, but I do believe this is part of a corrective rebound, targeting $158. Eventually, I think it will come back down again. Okay, I think I do not want to go any further because it seems that unless you have interest. Okay, if there's nothing else, okay, there's a new question. Let me get this new question. Okay. XRP, okay, someone want to see XRP. XRP is not really bouncing, okay, it's also quite dead. It has lost that momentum, okay. From a high of $3.64, it's dropped all the way to $1.39 and a half. And then after a brief rebound, okay, it's slipping back again. Although this past week we see that it has gained ground a little bit, but it is seen in the structure of the continuation correction. Okay, so overall trend is still bullish. If you can hold, I think it's still positive. Okay, the pullback from $3.64 is basically seen as a corrective pullback. Okay, in the daily time frame, prices are still below the cloud, so meaning to say that it is still not time to buy. But if the market actually close above the cloud, like something like this, okay, follow with very strong long candle bar, then it may actually be something I want to consider. Okay, but knowing that the Bitcoin is a little bit bearish right now, we are still in very much in the corrective mode. Perhaps we want to wait for further confirmation. Okay. This is the 4 hours. You can see it's trading marginally above the cloud, but it's quite flattish. You can see the price action over the weekend has been quite flattish. So it's not indicative of momentum. I want to see momentum, okay? Momentum either to the upside or to the downside, I'll be a player. But if the market has gone into consolidation at this, it's not my style to actually get in waiting for the big move to come, okay? The only exception is crude oil. Okay, crude oil, I'm prepared to wait for the return of buying interest. Uh, any more other than Suman? All right, if there's no other question, I thank you for your time and shall see you next Sunday. And going to December, we are going to be closing up the year. Oh, how about the Japanese carry trade? You can go and Google and understand what the yen carry trade is all about. It has been around for decades, okay? And it is the cheapest way to raise money, okay? Because Japanese interest rate is at one stage negative, okay? Meaning to say, if you borrow in Japanese yen term, you practically pay nothing, take the money and reinvest in a higher yield assets, whether it is US Treasury or the US dollars or to buy Japanese equities, okay? So it has been money managers go-to strategy, okay? Because you're borrowing at near zero interest and then taking the proceed to reinvest in another better yielding assets. So it's a very simple play, but it has been around for so long. But this is about to change because inflation now is coming into the Japanese economy. The risk of interest rate hike is already there. Okay. And when we look at the Japanese JGB yields at above 3%, it is you'll be illogical not to cover your sixes. Okay, if I am somebody who borrow in Japanese yen term and interest rate looks like it's going to be matching the JGB yield, okay, then there is no profit there anymore. Okay, I have to unwind my yen carry trade, meaning to say I have to sell off all the assets that I buy from the borrowing in yen and return back my yen loan. Okay, and if everybody does the same thing, it will cause the yen carry trade to unwind big time. Okay, nobody knows how big the yen carry trade is. Uh, like I said earlier on, $20 trillion was mentioned, and that is some serious money. Okay, if it's all unwind all at the same time, it will dislocate a lot of markets. Okay, guys, thank you very much. And like I say, I will wish you guys a great week ahead and a great month ahead. Bye bye, take care.